Okay, today let's deal with this topic called time series analysis. So time series analysis is also a very important topic under statistics. So let's deal with time series analysis. So time series analysis. So basically, time series analysis refers to analysis of series or sequence of observation on variables made over a long period of time or certain period of time. So a time series analysis is nothing but a series of observations that you arrange over a period of time to make different types of studies. For example, comparative or calculative. Example, production of rice in tons over 10 years, for example. So when you see this kind of curved or chart, you should know that this is a time series analysis. So production of rice over 10 years, which is measured in tons, for example. So such kind of study comes under time series analysis. Another example can be population study, for example. Another study can be price or inflation, which is also studied over a long period of time. So all this type of study comes under time series. So if you see this kind of chart, you should know that it's a time series analysis. Okay, why time and series? For example, time, it normally refers to, so the time series can be yearly, monthly, weekly, days, or hours also, or even decadal study also. It can be more than 10 years or century study over centuries, for example. So time refers to this measurement in terms of yearly, monthly, weekly, day, or hour, for example. Series is, why do we use the word series? Because we put in a sequence. Okay, so it's a sequential study of anything. It can be about production, income, population, consumption, investment, employment, etc. So it can be of any type. Okay, so we put it in a sequence in terms of like ascending order or descending order, for example. Normally ascending order, so that's why it is called series. So it's a time series. Time means referring to year or month or weekly calculation or daily calculation. Series means something, the unit is being put in a series, like yearly wise or monthly wise, for example. That's why. So time series means a study made over certain period of time on certain variables, be it production, income, population, consumption, investment, employment, etc. Okay, now what is the importance of time series? Importance of time series. Number one, it helps in study of cause and effect relationship. For example, we study about inflation, we study about deflation. So it helps us to study comparative study. It enables us to know why is inflation being caused. For example, inflation can also be caused by different factors, like we have this cost push inflation and demand pull inflation. So what is the cost to this inflation, for example? So this can be studied under time series. And what are the effects of inflation, for example? We can it can be understood by studying changes in prices using time series analysis. So it can be used in the study of cause and effect relationship. Number two is helps in forecasting events. So this is one of the most important, I should say, reason why we use time series analysis, that is to forecast events. For example, price forecasting, GDP forecasting, stock exchange. Stock exchange is one of the best example, I should say, where we use time series analysis to forecast what is going to happen in the next month or in the next hour or next year, for example. So if you're a stock broker or if you want to invest in stock, you should be very much well acquainted with time series analysis. Because time series analysis gives us the changing pattern, which helps us to predict what is coming ahead of us. Thirdly, helps in formulation of policies and control measures. For example, so let's say that there is an inflation going on. So what should be the control measure? What should be the measure to reduce inflation, for example? So that those are the formulations we can use by having time series analysis on a particular problem. Let's say it's inflation. So another important usefulness or importance of time series is formulation. It helps in formulation of policies and control measures. for example, measures of population control and all that, because we have already assembled the data and we have already studied and we have already found the cause and effect. So now we can formulate policies of how to control it. Helps in comparative study. So it also helps in comparative study. For example, comparative study of inflation for different years, for example. So we have a time series analysis done on inflation. So annual inflation rate is given. So it helps us to know the variation over time. So in 2008 it was around 4%, then it increased to 5% or over 5%, and then it stretched to 2019, which came down to about 2%, for example, inflation. So the inflation dropped over the years towards 2019, for example. So it helps us to make a comparative study on inflation for different years, for example. So this is just one example. You can also do that for production and employment, or be it population, etc. And then it also helps in comparative study of GDP for different countries. So this is another typical example, I should say. So this data I took it from IMF World Economic Outlook, April 2021. So this gives us the latest World Economic Outlook growth projection. So it is a projection on real GDP and annual percentage growth. So it helps us to see the different countries with their different GDP, their present present GDP level, and also the projected future, like predicted GDP rate for. So for it has been given for 3 years, 2020, which is already gone, 2021, which is the present year, and 2022. So let's take an example. So the world as a whole, we had a negative growth rate, minus 3.3, which has gone to a little bit positive, on a positive side, which is 6.0 actually, which is a good number. And then we are projecting it to be 4.4 in 2022. So if we go by the different categories, advanced countries, we are expecting it to grow by 5.5 this year, and then reduce it to 3.6%. So this is the best example of a comparative study of GDP for different countries being made by using time series analysis. So emerging market and developing economies, we are seeing a negative growth of minus 1% in 2020, 8.6, which is good, percentage of growth, and then 6.0 projected for the coming year to 2022. So this is the best example on how time series can help us in comparative study on GDP for different countries. So composition of time series. So what composes of time series? So a time series, normally when we see, it is a chart. Time series can be presented in the form of a chart, this manner. So time series can be divided into different components. So the first is called the circular trend. The circular trend is the long-term variation. It's a study of the long-term variation. So in this trend, or in this component, we will be taking the variables for a long period of time, like 10, 15, 20 years, for example, at a stretch. So it will be mostly a smooth curve. It will be mostly a smooth curve, which is going up or going down. So of course the curve will only turn up or down, can stay in the middle as well. But yes, it is based on long-term variation, and it will be normally a smooth curve. So when you try to study, at the average of growth for 20, 30, 40, 50, 100 years, it will be, a circular trend. You'll get the circular trend. Second is the cyclical variation. Now this is a regular curve, and then it will have peaks and troughs. Now the best example of cyclical variation is the business cycle. Cyclical variation refers to regular pattern, cycling up and down. It comes in a cycle. It comes in a cyclical manner. So it will have the highest point and the lowest point. The highest point is called peak, and the lowest point is called trough. So the best example is the business cycle. So when the business goes up in the economy, yeah, we will then peak. For example, when the business goes down, you know, someday we will go down and reach drop, for example. So it's a cyclical. The business cycle is the best example for cyclical variation because it comes in a cycle. For example, within 10-20 years it comes back again. The best example of business cycle, the Great Depression of 29-30, where the world economy faced, especially the US economy faced a complete drop, for example, depression. And then after that, 2008 in India, or the whole economy experienced some sort of recession. So it comes back again, back and forth because of Corona. Again, majority of the countries are in a state of recession again because of Corona. So so it was there in 2008. Now it has come back in 2020, for example, or 21, for example. So it's coming in a cyclical manner. So that's why it's called business cycle. So the best example of a cyclical variation is a business cycle. Seasonal variation. So within that cycle, let's say within a 10-year or within a year, we still have short-term variations like seasonal variations, like weekly, monthly, yearly variations. So sometimes our output would be high in this season, sometimes our output would be low in that season, for example. So seasonal variation, example, rainy season, harvest season, temperature, changing temperature. For example, during summer, the average of the temperature in Nagaland would be like 29-30, for example. So seasonal variation refers to the changes that is taking place in the economy, or the calculation done based on the changing season, which are normally in terms of week or month or yearly, so those comes under seasonal variation. So normally we'll see a chart like this. There are uniform pattern going throughout the curve, so in spite of the changes that is taking place, every year the season comes back again. So there's some sort of uniformity. There are changes, but still then there are some sort of uniformity. That's why we get this this uniform curve, upside as well as downside. So uniform patterns. So because it's a seasonal thing and it comes back every year again. So seasonal variation is a short-term variation which may be based on weekly, monthly, yearly analysis. Best example, production during rainy season, or harvest, or changing temperature, for example. Okay, last but not least is random or irregular movement, represented by the letter R. So here another some of the important features of this random irregular movement is it lacks in uniform pattern, unpredictable events. So best example is war, flood, droughts, political crisis, etc. So what basically random movement measures is it measures those variations which are very unlikely and unpredictable. For example, nobody can predict necessarily war. Nobody can exactly predict flood. For example, to some extent, meteorological information can help us to predict, but then nobody is precise about it. Earthquakes or droughts, or for example, political crisis, for example. So all of this irregularly moving patterns comes under this random movement and random movement. So this is also another component of time series, which measures the irregular patterns, irregular changes in the given data, or you can say economy as well. Last but not least, we will study in this unit is the determination of trends. So how would you determine the trends? So there's basically 5 ways of doing it. First is the freehand writing. The second is the method of moving average. The third is the high and low midpoint method. The fourth is the semi-average method, and the last but not the least is the mathematical function method, where we will be using least square method to calculate. So these are some of the ways of determining the trend. Trend means these movements, okay, variations. So how do we measure? So we can measure by using different techniques or methods, like the freehand writing, where we'll be using a freehand draw the curve. And another method is the method of moving average. We'll be using different types of moving average: 3-yearly moving average, or 4 months, or 3-year, 4-year, 5-year moving average, for example. And then high and a low midpoint, we'll be choosing the highest value and the lowest value, and then club it together, and then find the midpoint divided by 2. Semi-average method, and then a mathematical method. So those are some of the measures, ways in order to determine what kind of curve we have, for example. So this is the rough introduction to time series analysis. So what is time series analysis? It is an analysis of a series of observation. Okay, you can put it in a series. Why it is a series? Because we take it over a stretch of years, like for 10 years, 5 years, 20 years, for example. So that's why it is a series of years, or series of observation on variables. So variables means anything. It can be production, income, population, consumption, investment, employment, etc. So observation on variables meant over a period of time. So it can be for 10 years, 5 years, 10 months, 10 weeks, for example. So time series because we calculate in terms of time, and then series because we put it in a sequential manner. So it's a sequential study of these variables. So I hope that is clear. With that, we are done with the introduction to time series. So thank you.